just about 50-point uptick on the index. But the broader end of the markets, that's where the pain lies, because the mid-cap index is down 1.5% as we speak. And look at the advanced decline ratio on the NSE, it's almost 1:4, replicating what happened yesterday. So yes, pain in the broader market is visible. Let's see whether or not the headline indices manage to hold on to these slim gains or not. But on that note, let me bring on board our next guest for today. Joining me is Aditya Khemka, who is a fund manager at InCred Asset Management. Aditya, lovely to have you on the show, interacting with you after a long time. Wishing you a happy new year. Not really turning out to be such a great year for the market. But in the wake of the recent volatility, would you expect a larger drawdown going forward, or do you think the worst is priced in and we are somewhere near the bottom right now?
No, so I think the worst may not be really priced in. If you look at the broader market earning growth, be it Nifty 50 or BSE 500, the YOY earning growth seems to be in the ballpark of 7 to 10% for the first half of FY25. Whereas if you look at the valuation multiples, still we seem to be 10-15% premium to historical PE multiples that these indices have traded at. Whereas the historical earning growth has been between 14 and 15% for these two indices. So clearly we are still, the corporates are still reporting below historical averages PE earnings growth, whereas the valuations are still above historical averages, which gives me a sense that we may be done with maybe absolute price correction, but there may be some time correction ahead of us till earnings catch up with the multiples.
Right. But would you say that it's still not the right time to buy and perhaps wait on the sidelines, because earnings season has just started, has lacked excitement, and as you said, it is still above long-term averages, right? So what should the strategy be really right now? Because we also have a budget coming in, and Trump's inauguration has already happened, but nothing really has come out, nothing concrete has come up on how he would put tariffs on India as of now. Looking at the kind of language he's adopted, how should one really navigate? Is it time to buy or wait it out?
No, I think, we are, at least in our funds that we manage, we have started to put money to work. We are deploying, albeit at a slower pace. So we are still holding on to some cash, but we have started deploying in stocks where we feel the margin of safety has significantly improved from what it was, let's say, 3 months back. So what I would suggest to most of your viewers is to start deploying, but maybe do it in a staggered fashion, so that, by maybe around by the middle of February or end of February is perhaps where, you should be completely deployed. I think that's where the market is probably like to bottom out, because all the narratives of the Trump, initiatives and the budget implications will probably be priced in by the time we are in mid to end February of this year.
One interesting point, I had a chat with one of the fund managers, and he pointed out that, capital protection should be the theme this year, because, returns may be muted in the wake of how earnings growth is panning out. Any themes that one should deploy in, particularly to protect capital and then perhaps look at gains? So for capital protection, which are the pockets one should look at?
So in terms of capital protection or capital growth, I don't differentiate between the two, because in my view, if you are in equities, we are really there to make more than fixed deposit returns, beat any time frame, right? So the way we are deploying capital at this point is twofold. One, we are deploying in companies which are more exposed to non-discretionary consumption. For instance, healthcare companies, their growth rate would probably be better than the broader market in terms of earning growth, because the consumption there is relatively non-discretionary when you compare it to the broader cyclical buckets. So that's one pocket we're deploying. And second pocket is, for a capital protection standpoint, maybe you could deploy money in stocks where dividend yields are slightly higher, north of 4 to 5%. I think that's where, you find more valuation comfort, more margin of safety in a market which is, behaving sideways as we have seen for the past 6 months. So capital protection may be dividend yield, but, our investment strategy has always been to find growth at reasonable value or growth at discounted value. And you'll be surprised to know that there are still pretty good names, a good number of names which fall in that bucket at this point, where earning growth will be north of 15% even for this year, and the valuation multiples are not too steep. So we'll probably still end up making some money for our investors.
Okay, where do you stand when it comes to specialty chemicals and in the entire China+1 theme? But because Trump, if you look at his commentary on how he wants to put tariff on China, it's been softer than expected, right? We were hearing 60% and the likes, but he's so far said that 10% maybe starting February. In light of that, China+1, do you think we are poised to look at that theme going forward, or do you think the softer tone could not really translate into that kind of growth for China+1, particularly specialty chemicals?
So China+1 basically is happening across many sectors, including specialty chemicals and pharmaceutical API, right? So within specialty chemicals, my sense is that many of these stocks, although the earnings have fallen over the past 2 years, the multiples haven't really corrected significantly, which means some sort of a recovery in earnings is already baked into the multiples of the specialty chemical stocks. And hence, when you buy these stocks at current valuations, the risk you take is if the earnings do not revive the way it's being expected, then you might end up losing some part of your capital. So that is where we actually are not very keen to deploy capital at this point, because we still feel multiples are slightly elevated and hence discounting some of the potential future revival in earning growth for these specialty chemical stocks. So that's a bucket we are still avoiding, because in that bucket we still see more downside compared to the upside that the bucket offers. What we are basically focusing more on is the pharmaceutical API space, where we feel that the China+1 is going to be equivalent, in terms of how it is for specialty chemicals, and their valuation comfort is significantly higher when you compare it to specialty chemicals. So between the two buckets, the call is clearly for pharmaceutical API. But if you just were to discuss specialty chemicals alone as a bucket, then within that bucket, maybe there's just a couple of names where they look interesting enough to deploy. But the larger part of the bucket looks like something which one should avoid at this point.
Sure, point taken. Aditya, in terms of your expectations from the budget, would you expect the government to maintain public spending with capex growth, or do you think in light of consumption slowdown and even signs of slowdown in the economy, the government would dole out steps to boost consumption? Which way do you think the priorities would lie this time around?
So look, we were amongst the first fund houses. I think we were talking last year about a consumption slowdown, and I don't think that was largely being talked about last year. So we actually foresaw this happening. We foresaw consumption slowing down, and if you see the portfolios that we manage, we are mostly overweight healthcare in those portfolios because that's slightly non-discretionary consumption, and that has done well for our funds in the past couple of years for us. Having said that, from the budget, what we expect the government to do is basically to maintain the pace of public capex, because that remains a critical pillar of GDP growth for us at this point, because private capex has clearly slowed down following slowdown in consumption. So the public capex will definitely be something that we'll watch out for, and we feel that number should go up substantially to maintain some GDP growth. On the second part, on consumption, we feel government might boost allocations to programs like Manrega, etc., where they will create employment through government programs, which will again help rural consumption. But urban consumption, I think, is something which the government may not be able to do much about, because to boost urban consumption, you have to cut personal tax rates, which is something I don't think the government has looked at for the past 5 years, and I don't think there is enough talk in the street about any potential cut in personal tax rates. So I think urban consumption for now will be slow in the foreseeable future, maybe a year or 2 or 3. But rural consumption is something where we feel that there will be some revival, and it will be government programs like Manrega, which will have higher allocations, and government capex, which will result in more cash in the hands of the rural population, which will result in better rural consumption.
Sure. And in terms of your own wish list from the finance minister, anything that you would like to share with us?
Well, my wish list is something that the finance ministry may not agree with, but what I would love to see is maybe some reversal in the tax rates of individuals, some lowering of tax rates there, so that some urban consumption can get a push. Also, maybe you may increase corporate tax rates slightly to compensate for that reduction in personal tax rate, because corporates would be happy to pay a higher tax rate as long as their revenue growth and their profit growth is substantially higher than what they have been able to do for the past year or so. So I don't think corporates mind paying a higher tax rate on a higher profit base. But if your profit base itself is small, the smaller tax rate doesn't really help. So I think if you ask my viewpoint, I think the government needs to sort of look at personal taxes, which are very, very high in our country, and it's suppressing consumption dramatically. And I don't know if that is something that's on their radar, but that's my wish list.
I think that's the wish on the wish list of a lot of us as well. But Aditya, last couple of questions really. What is your take on this entire quick commerce battle that's playing out? We already saw how it panned out for Zomato in its earnings. Margins from the quick commerce business weren't all that enthusing. EBITDA loss was reported, and a lot of capital being diverted to quick commerce, not gradually but at one go, which is what of course is impacting. In light of that, how would you view these companies? Also, some of them saw a good run up as well already. So, in terms of valuations as well, do you think it's a good space to get into? Because, of course, we have seen weakness pan out for some of these companies. Look at Zomato, lost almost 20% in a matter of 2-3 sessions. Would you look at an entry at these levels?
So unfortunately, in our investing framework, companies that burn cash are not assets, they are liabilities. Even though future, you might predict a future where they will be cash flow rich. That's okay. That's something we will tackle in the future when they become cash flow rich. So we do not invest in companies or even look at companies that do not generate cash flow. And unfortunately, companies like these quick commerce companies fall in that bucket. They are burning cash to garner revenue. That's in our mind not a business. In our mind, that's basically playing with the liquidity that you are being offered by various kind of investors. And we are happy to surpass such opportunities. We are happy to forego such opportunities.
Okay, that's the view on quick commerce. With that, Aditya, I would like to thank you for taking out time and joining in and sharing your thoughts. I would like to connect again, maybe post budget, and discuss all the steps that the government really announces in the budget.
Thanks for having me. Look forward.
Thank you. Well, then, on that note, for the market, still in the green, at least on the index level, but looking at the broad end of the markets, there is a fair bit of pain there. 1.5% cut on the mid cap index. The Nifty Bank index has also given up its early gains, in fact, now trading in the red. And if you look at some of the movers, on the losing front, BEL, Bharat Electronics, that's the top laggard, 2.5% cut. Power Grid close second. We have Tata Motors, Coal India, Adani Enterprises, HDFC Life, Trent and ONGC. In fact, even BPCL ahead of numbers is now in the red. What's holding up? Tech names, Wipro, Infosys, TCS, all of them holding out. Even Tech Mahindra for that matter. Sun Pharma doing well, Dr. Reddy is doing well. So some of the defensive names are doing well. And so are stocks like ICICI Bank and Kotak Mahindra Bank. But of course, HDFC Bank also trading in the positive zone ahead of numbers. So HDFC Bank, HUL, these are the big numbers to watch out for aside of BPCL. But with that completely timed out on this edition of Opening Bell, thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates, and of course come back and join us on Closing Bell at 3:30 p.m. as well. Have a good day.